As part of our Powerhouse road trip, a realtor told us that deals were starting to slow out there. Today, she says they're at a near standstill as mortgage rates rise and buyers panic. Let's bring in Stephanie Vitaco, broker associate with Equity Union in Los Angeles and Southern California. Stephanie, welcome. Good to have you with us. Is what's happening here that buyers are afraid that prices are going to come down, so they don't want to put in at 1.3 million on a property that's going to be 1.2 or 1.1 in a few months, and sellers just haven't gotten the message yet that they've got to ask for lower bids?
So absolutely. So what's happening is the sellers are starting to get the message, but they're definitely resistant because, of course, they saw their neighbors get these incredibly high prices just a few months ago. But what's happened in this shift, and I've been doing this for well over 25 years here, and I've never seen it happen quite so fast. So a loan in March for $1 million would have cost a buyer around $4,100 a month. That same loan is now at about $6,500 a month. And it's buyer, the affordability just can't keep up. So where a year ago we had prices just climbing, interest rates were so low, so the buyers weren't afraid to spend. But what's really interesting is people found it psychologically easier to overpay by several $100,000 than right now they can get a much better value as prices are shifting. So but we've definitely seen about 10 to 20% decline since March. And I would say that, you know, there's no bell that goes off at the top or at the bottom, but I would definitely say that March would have probably been the peak if we were to
So
try to
prices in your market are off 20% since March?
So I have a very specific property, and this I could give you stories all day long, but yes, a property where in March it would have sold for $1.2 million all day long. We listed it at $1.2 million because they were a little late in getting to the market and they wanted to try. We adjusted it to $1.195 million, $1.1 million. Then we dropped it down to $1.15 million. We got it to $999 and sold it for $980. So yeah, that's 20%. And
our
it's
prices,
like that in all price
going back to our previous segment where we were looking at a change in the rate of change of prices, are prices higher, despite this decline? Are they higher than are the transaction prices higher on average than they were a year ago still, or are they not?
Yes, we are probably back to sometime in maybe first or second quarter of 2021. It's hard to say exactly where. So the good news is, and that's what everybody forgets, the good news is our prices are still higher than where they were. They're just not as high as that crescendo that we experienced. But it's still unaffordable.
What do you think breaks what breaks the logjam here? Is it sellers becoming more reasonable about the market that is, not the market that was, or the market that they're hoping will happen? Or is it that mortgage rates, I mean, we've sat at low mortgage rates for so long that, I mean, people in the last 10 years, if you bought your first home, that's all you've ever known is rates below 4%.
Absolutely. So, and that is part of the real estate gridlock. So just about anybody who's purchased since 2012-ish, they're somewhere in the 2.5% to 4% range. So that's a very hard thing to give up. So what we're seeing now is more mandatory sellers than discretionary sellers. A year ago, everybody was like, let's get a bigger house. It will cost, actually, in many cases, it cost them the same or less because they were trading out of a 4.5% or 5% interest rate to a more expensive home, but at 2.75%. So it was worth the shift. So now those people are like, you know what, we're good where we are, we're going to stay put. But the people who need to sell or really want to sell are making the move. And another thing that we're doing in our market, and we haven't done this in years, but I'm asking every single one of my clients that has a low interest rate, is your loan assumable? Everybody looks at me and says, what? We haven't done assumable since the 90s. So, but if you have I have a client right now who has a 2.75 30-year fixed loan. So what we'll do is we'll have the buyer assume that loan. They'll have to get a small second for the difference because the price is too great. The seller's equity is still too great for the difference. But it's about getting creative. I've also started having where we're factoring buying points. So I'll have my seller buy points. And when I say seller, it gets financed into the loan, but it becomes part of the overall package. So it brings the payment back down, so you can get maybe a 5%
really
rate
creative for the realtors, for the
stuff.
buyers and sellers. You got to wonder whether the banks, facing this are like, not that, anything but that. Stephanie Vitacco, thank you for joining us. We appreciate that.
Shepard Smith here. Thanks for watching CNBC on YouTube.